Support and resistance. Now, this is a very, very important component, technical component, to understand in foreign exchange trading and in all trading for that matter. Do not take this lightly and do not overlook this section because it is critical, particularly for the scalping approach to trading. Now, the first thing I want to explain to you is how the market moves. It spends about 80% of its time in ranges and bouncing off of levels of support and resistance. And there are ranges, there are large ranges. The market will trend within very large ranges, which are visible on the large time frames like the daily and the weekly charts. And then, of course, within those trends and ranges, there are ranges within inside ranges and ranges and ranges inside of ranges on the smaller time frames, as you will see as we break this down slide by slide, starting with the daily chart. Now, starting over here on our left, we see that price has formed a high here, and then at a later date it came up and tested this high. We came down and formed a low down here, and price came down, tested that low. We had some deviant price move through it, which happens very, very regularly, but we effectively traded in this range for a while before moving out. Once it moved back into this range, we see that this range held for a period of a couple of weeks, and then it moved out. We started to trend. The market formed a high, but look at how when it retraced, even during these days, we were in a range for this period. Then it moved out, and then we traded in a range for a period of a few more weeks. Then it moved out, and we traded again in a range for several days. Then we trended. But the trends all taking place within a larger range, and as we see that this trend, when this trend broke out, we see this level of resistance. It later became support to the market. Then price moved back into its longer term, wider range and has trended up and trended down. And we see in these price swings that the market had been trending, but within inside of each of these moves, we will see micro consolidations, which are going to be imperative to your scalping approach to trading. Price comes down, we trade in a small range before breaking out again, but all the while we are in a still contained within a larger range, and then price rallies and it attempts to move above these highs. As each high, as the highs hold, and the market comes back into its range. Now, this is the market's way of saying we believe that the two currencies or the two economies that are relative, so for example this is the pound dollar, so the economy in the UK and the economy in the US, we believe that the economic scale, that this is the valuation that we place as a price reference, or this is how we will price these two economies of scale between 192 and 186. They believe that that's a fair valuation for that currency pair. Just like if you are trading a stock, the market analysts will come up with estimated evaluation of a specific stock, and then therefore often the market will price it in accordingly, what they believe the value of that company is worth in terms of its share price. Very similar in the foreign exchange market. This is the valuation that they believe is a fair exchange rate for the UK and the US economies. Breaking it down further to a 4-hour chart, we are looking at how price responds to specific levels and maintains its ranges. Here we see price stays in a range for several hours. It moves out, stays in a range, it moves out, trades in a range. But again, look at how the market respects previous levels. Where a level of support was established here, it now becomes a level of resistance to the market as the market works to break through, trades in a range, then moves out. Reprices itself above this high. This high becomes, which was resistance, now becomes support. The market trades in a range, it moves out, then trades in a range, it reprices and moves out, then trades in a range for an extended period of time. It reprices and moves out, and again trades in a range, coming down to the previous level of support and responding to that level. It moves out again, rejoining a range that was previously established between 190 and 190-100. And again it moves out, trades in a range, moves down, trades in a range, and so forth. Reprices, trades in a range, reprices, trades in a range. Now, what you are to glean from this slide is the percentage of time that the market maintains a range-based pricing versus the amount of time that it actually moves out of its range. Therefore, if we've determined that the market spends about 80% of its time in a range, whether it be a macro range or a micro range, therefore we should then conclude that the majority of the trades that we take in the market should be under the assumption that the market will maintain its range, and we have to trade off of significant or key or ideal levels of support and resistance. Breaking it down further to a 60-minute chart, I've just taken this example which has a tightening range or a descending pennant, a tightening range, but look at all of the smaller ranges within the tightening range. Okay, we have a range, a range, a range, and again, look at the small little ranges that it trades within. Now, these are each 1 hour candlesticks, and if you're sitting at your computer watching price ticks, 1 hour is a long time. And if you see here that we see several hours in a row before a price move, then several hours before a price move, and several hours before a price move, then it's important for you to understand the amount of time that you may have to endure sitting watching price stay in a range before it moves out. And again, once it moves out, this level of support becomes resistance as the market has ranged, and we see some volatility pick up here. The range from this low to this high, price moves out, and then this low now becomes the defining point of resistance for the subsequent range as price continues to move down. Breaking it down even further to a 15-minute chart, the market moves in a range, it breaks out. This high, which was a level of resistance, now becomes a level of support of this range. Price moves out and then trades in some micro ranges at the top. You see how this level of support, price moved through, and then it becomes a level of resistance to the market as we move forward. And then once again, this key price level here. You see the bodies of the candles here? These bodies are very defining in terms of the interest point at which the interbank dealers were trading. The wicks are often short and errant price action. But we see here how the levels are respected and viewed and remembered in the minds of the bank traders. And then we see price move out, come down, it bounces off this low. First of all, it bounces here off of this low. You see the bounce? And these are the little bounces that we are going to need to acknowledge once we start scalping in the market. So we have a bounce here, then another bounce here at this low, then another bounce here at this low right here. So we see as prices move down, it bounces again, and it bounces again, and it bounces again. And these bounces at key price levels are going to be areas where we are going to be watching closely, which we call reaction levels. The market comes down and reacts or bounces, reacts, bounces, reacts or bounces. These reaction levels are the areas at which we are going to work to make small pips off these bounces. Observing now a 5-minute chart, I just want you to see a more magnified level. You see how we're breaking it down, how we have ranges within ranges within ranges, or price reaction within the larger scale. So price comes down, makes a level of a low or level of support. It moves through the high. The high becomes the price reference point for the dealers that they now do not want to move below. Boom, it comes down and bounces, stays in a range for a while. The high gets tested again and again and again, and finally price gets weak and moves off of the high at 28.30. It comes down. This low becomes a level of resistance. I just want you to get an understanding of how the dealers are thinking. And when the dealers move price below this notable, first of all, above this notable high, they hold it, and then it moves below the notable low, then it holds, and it becomes a price reference point for future trading. Then price moves down. It penetrates the low, which is going to be a key level held in the mind of traders, and then it deals in a range for several hours, and price moves through, and now that level of support, which became resistance, now becomes support again at 2800. These price levels are etched in the minds of the interbank dealers, and they just know when huge volumes and huge transactions are taking place through their dealing desk, they remember these numbers distinctly throughout the day, and they become primary reference points to the bankers. They become very important numbers etched in their minds, and therefore are the reference points that are used throughout the day as levels off of which they will deal. And therefore we see volume changes at those prices, and therefore price shifts as a result of the volume changes.